Today, I'm talking about how federal disaster zones can affect your taxes. There's a lot of ways, and honestly, I found some new things I didn't know about doing some research for this. Firstly, and most importantly, if you live in a federal disaster zone, it's pretty common to get a filing extension. Sometimes it's a few months, but people from the hurricane that hit North Carolina last year have until, I believe, May 15th of 2025 to file their taxes if they had asked for an extension already. So that's about a 7-month extension. If you have property that was damaged and you get insurance money to compensate you, that insurance compensation, like all insurance compensation pretty much, is tax-free. If it's not covered by insurance, you can claim a loss for the value of the property you lost. Even more importantly, you can claim it a year early. So if you were somebody, unfortunately, who lost property in the California fires this year in 2025, when you file your 2024 taxes in April of this year, you can claim that loss in 2024 instead of waiting until 2025. If you have a business, you can write off any losses for things like destroyed inventory equipment, the cleanup costs, or the repairs. If you're in a federal disaster zone and you need to take money out of an IRA or a 401k, there are ways to do that where you can avoid the 10% early withdrawal penalty if you're not yet 59 and a half. You're typically still going to owe taxes on it if you would owe taxes anyway, but this avoids the withdrawal penalty. Even better, you can repay the money into your retirement plan. If you do that in the time period allowed, you can avoid the taxes and also get that money back in there faster than maybe you could otherwise. A really cool thing, and this is the one I didn't know about, is a 1033 exchange. So a lot of people in real estate have heard of the 1031 exchange. If your real estate is damaged in a disaster and you sell that property and use the money to buy another similar property, you can avoid all of the capital gains on that sale. Unlike the 1031 exchange, you may have 2, 3, very rarely even 4 years to complete that purchase of a new property. And the way it works is basically you maybe pay the taxes up front, but you'll get that money back when you buy the new property. So if you have, I know we have at least one listener who a tornado took out his property on the coast of South Carolina a few years ago. This way, yeah, it sucks that it was destroyed, but when you sell and buy something new, at least you're not going to get hit by capital gains if that property went up in value. If you have any of these losses, you are going to want to work with a CPA or an accountant or an attorney to make sure you get everything that you're entitled to. Most CPAs don't really know much about these things. It's really kind of scary how little some people know about these. And again, even as I've admitted, there were some of these provisions I didn't know about because, frankly, they come up so rarely.